Hey everyone, my name is Alex Morgan, and welcome back to the channel. Today we're breaking down one of the most critical price levels in this entire crypto cycle. Bitcoin is trading around $68,000. That number isn't random. It isn't just another checkpoint on a chart. It represents a psychological battlefield, a structural pivot zone, and potentially the launchpad for the next major expansion toward $100,000. The big question right now is simple. Does the road to six figures start here? Or is this just another consolidation before volatility shakes the market again? In this deep macro breakdown, we're going to analyze fresh market data, ETF flows, on-chain positioning, global liquidity conditions, institutional behavior, and we'll also connect this to the silver market, because the forces moving Bitcoin are increasingly the same forces influencing precious metals. Let's begin with price structure. When Bitcoin reclaims and stabilizes around $68K, we are revisiting prior distribution zones from earlier in the cycle. Markets remember where heavy volume previously occurred. These areas often act as supply walls on the way up and demand floors on the way down. What makes the current situation interesting is that dips toward this region are being absorbed relatively quickly. Buyers are stepping in rather than hesitating. That absorption behavior matters more than headlines. Volume is stabilizing. Volatility has compressed compared to prior breakout attempts. This kind of tightening often precedes expansion. Markets rarely move from chaos to explosion instantly. They coil first. And right now, Bitcoin is coiling around one of the most important psychological levels in the cycle. But price alone tells us very little without liquidity context. Bitcoin is a liquidity-sensitive asset, more than equities, more than commodities, more than most currencies. When global liquidity expands, Bitcoin thrives. When liquidity contracts, Bitcoin struggles. Over the past year, central banks globally have shifted from aggressive tightening toward cautious stabilization. Real yields are no longer accelerating upward at the same pace. The US dollar index has shown fatigue after strong runs. Liquidity contraction is slowing, even if full easing hasn't begun. This matters because Bitcoin historically anticipates liquidity shifts before they become obvious in mainstream economic data. In previous cycles, Bitcoin began major uptrends months before formal policy pivots occurred. Markets move on expectations, not confirmations. Now let's examine institutional demand. Spot Bitcoin ETFs have transformed the demand landscape. We're no longer operating in a retail-dominated ecosystem. Pension funds, asset managers, structured product desks, they now have seamless exposure. During recent pullbacks, ETF outflows were controlled rather than catastrophic. That suggests institutions are accumulating strategically rather than panicking. ETF flow data shows stabilization near this $68,000 region. That stabilization indicates buyers are comfortable deploying capital here. If ETF inflows expand while price consolidates, it sets up supply-demand imbalance. And Bitcoin is a supply-constrained asset by design. On-chain metrics reinforce this narrative. Exchange balances continue trending lower over long time frames. Long-term holders are not distributing aggressively into this rally. When coins leave exchanges and remain dormant, available supply tightens. That doesn't guarantee immediate price expansion, but it creates structural fuel for future moves. The halving cycle also cannot be ignored. Bitcoin's issuance rate has been reduced again. Historically, the strongest expansions occur 12 to 18 months after halving events. We are entering that window. Previous cycles show a pattern: accumulation phase, breakout phase, acceleration phase, euphoria phase. Right now, we appear between accumulation and acceleration. But what could derail the road to 100K? If real yields spike unexpectedly, if inflation reaccelerates sharply and central banks return to aggressive tightening, if global risk sentiment collapses due to geopolitical shocks, Bitcoin remains volatile. Corrections of 20% within bull markets are normal. Investors must respect that volatility rather than ignore it. Now let's connect Bitcoin to silver. At first glance, they seem unrelated. One is digital scarcity. The other is a tangible metal with thousands of years of monetary history. But look deeper and you see similarities. Both are alternative stores of value outside traditional fiat systems. Both respond to liquidity cycles. Both attract capital during monetary uncertainty. Silver differs because roughly half of its demand is industrial. Solar panels, EV infrastructure, semiconductor electronics, these are structural growth areas. If global growth stabilizes and electrification accelerates, silver benefits. If liquidity expands and real yields decline, silver benefits again. Silver recently experienced volatility after sharp corrections earlier in the cycle, But structurally, mine supply growth remains modest. Environmental regulations, declining ore grades, and geopolitical constraints limit rapid production expansion. Demand from renewable energy infrastructure continues rising globally. If Bitcoin accelerates toward 100K in a liquidity-driven expansion, silver may follow as part of a broader alternative asset rotation. Historically, silver often lags early in cycles and accelerates later as speculative capital rotates into undervalued hard assets. Now let's examine sentiment. Funding rates are elevated but not euphoric. Social engagement is increasing but not parabolic. Retail participation is rising gradually rather than explosively. These are signs of an expanding but not overheated market. The true mania phase, historically, includes aggressive leverage, extreme media hype, and vertical price action. We are not there yet. Miner behavior is another key variable. If miners flood the market with supply during rallies, it caps upside. Current data suggests miners are selling strategically, but not aggressively dumping. That controlled supply dynamic supports consolidation rather than collapse. Macro risk remains the wild card. Fiscal deficits remain historically high. Global debt continues expanding. Governments require monetary flexibility. Over long time frames, scarcity assets tend to outperform fiat debasement cycles. Bitcoin is increasingly positioned as digital gold within that narrative. Silver, meanwhile, stands at the intersection of monetary hedge and industrial necessity. In a synchronized liquidity expansion, both could benefit. In a growth scare with tightening conditions, both could face volatility, though silver's industrial demand may soften in that scenario. Let's outline possible forward paths. Path 1. Soft landing and gradual easing. Liquidity expands slowly. Bitcoin breaks above $68,000 convincingly, targets prior highs, and momentum builds toward $100,000 over quarters rather than weeks. Silver rallies alongside, potentially retesting prior resistance levels as both monetary and industrial demand align. Path 2. Sideways consolidation for months. Bitcoin oscillates between $60,000 and $75,000 while liquidity signals clarify. Silver trades in a broad range as well, waiting for macro confirmation. Patience becomes critical. Path 3. Sharp volatility event. A surprise macro shock pushes yields higher or triggers global risk-off behavior. Bitcoin retests lower support zones before resuming broader trend. Silver could dip initially but stabilize if safe haven demand emerges. Probability currently favors controlled consolidation with upward bias, but markets never move in straight lines. The most important signal to watch is sustained acceptance above $68,000, not just brief spikes, but weekly closes with volume confirmation. If that happens, market structure shifts dramatically. Momentum funds step in, media coverage increases, retail flows accelerate. The path to $100,000 is not about one candle. It's about structural transition from hesitation to conviction. And silver? If liquidity accelerates globally, silver could see renewed investor interest. If industrial demand continues strengthening through renewable infrastructure expansion, silver gains dual support. But it will remain volatile. Historically, silver amplifies both gains and losses relative to gold. Risk management is essential in both assets. Position sizing matters. Leverage amplifies noise. Scaling entries during consolidation reduces emotional decision-making. The broader theme here is liquidity. When liquidity expands, alternative assets outperform. When liquidity contracts, they struggle. Right now, contraction momentum is slowing. That's why this $68K level matters. Bitcoin is not just a speculative instrument anymore. It sits within global asset allocation conversations. Silver is not just a commodity. It sits within electrification and monetary hedge narratives. The convergence of digital scarcity and physical scarcity themes may define the coming cycle. If Bitcoin holds above $68K and liquidity conditions gradually improve, the road to $100K is not unrealistic, but it will not be linear. There will be volatility, there will be shakeouts, there will be narratives that attempt to derail sentiment. What matters is structure. Structure currently shows absorption rather than distribution. That's constructive. So here's the big takeaway. $68K is not just a price, it's a decision point for the market. Acceptance above it signals continuation. Rejection below it signals consolidation. Watch ETF flows. Watch real yields. Watch exchange balances. Watch miner supply. Watch global liquidity indicators. If those align, acceleration becomes likely. If you found this deep macro and cross-market breakdown helpful and want continued analysis on Bitcoin, silver, liquidity cycles, and institutional capital flows, Make sure you hit the subscribe button and turn on notifications so you don't miss the next update. Drop your view in the comments. Does the road to 100K start here, or do we need one more shakeout first? Thanks for watching. I'm Alex Morgan, and I'll see you in the next video.